Welcome to the ProTicker Deep Dive.
It is great to be here.
We are absolutely thrilled to have you with us today, whether you're commuting or prepping for a major asset allocation meeting, or maybe you're just intensely curious about the tectonic shifts happening in the global economy right now. You are in exactly the right place.
Yeah, you really are, because there is just a massive amount of ground to cover.
There really is. We are stepping back today to take a customized panoramic look at the massive macroeconomic, geopolitical, and technological forces that are completely reshaping the world. And as of March 2026, I mean, the landscape is just wild.
It really is a staggering landscape to take in at the moment. The sheer volume of competing and honestly often contradictory signals flashing across the market dashboard, it's unlike anything we've seen in recent memory.
It's incredibly noisy out there.
Very noisy.
And that is exactly our mission today for you, the listener. We are going to cut through that noise. If you've been watching the tape or managing your own portfolio, you already know the start of 2026 has been a complete roller coaster.
To put it mildly.
Right. We're seeing equities slipping in real time. Inflation is behaving like a stubborn guest who just won't leave your house.
Won't leave and keeps eating all the food.
Exactly. Plus, we have a brand new administration's fiscal policies taking immediate effect, and sudden military conflicts are sending absolute shockwaves across global supply chains. So our goal today is to unpack the underlying data and figure out what is actually driving the global economy beneath those sensational headlines.
Which is much harder than it sounds.
It is. And to help me synthesize these massive interconnected trends, I'm joined by our resident expert. When you sit down and look at this incredibly complex environment, how do you even begin to frame it?
If we connect this to the bigger picture, what we are really looking at right now is a market defined by multidimensional polarization.
Multidimensional polarization.
Yeah.
Okay, what does that look like in practice?
It is essentially a massive, high-stakes tug of war. On one side of the rope, you have booming corporate earnings and a level of technological investment that we really haven't seen since the build-out of the early internet.
Right, the AI boom.
Exactly. But then on the exact opposite side of that rope, you have stretched, highly fragile equity valuations and a global economy that is fracturing across multiple fault lines. We're talking geopolitically, demographically, and socioeconomically.
It's a tug of war where the rope feels like it could snap at any second.
It is a delicate balancing act, yes.
Mm.
And the margin for error in navigating it correctly has shrunk to almost zero for investors.
Okay, let's unpack this. Starting with the foundation of it all, the macroeconomy. Because right now, if you just glance at the headline numbers, the baseline looks surprisingly resilient. But I know there is some serious friction hiding just beneath the surface.
There is a lot of friction, yeah.
For instance, the U.S. GDP projections. They are pointing toward a solid 2.0 to 2.4% growth for 2026.
Which is a highly respectable expansion.
It is. But then we run into this glaring stall in the disinflationary process.
Precisely. The engine of economic growth is still humming, but the brakes are dragging heavily.
Right. We were all watching the consumer price index, just kind of assuming it was on this beautiful glide path down to the Fed's target.
Everyone wanted that soft landing narrative to be true.
But the descent has just abruptly stopped. The headline, CPI is hovering right around 2.4%, and core inflation is parked at 2.5%. We know that structural issues like shelter and auto insurance are keeping that core number elevated, but there's a new variable in the mix now.
There is, and to understand why the disinflationary momentum has hit a wall, we have to look impartially at the significant policy shifts that just rolled out, specifically the mechanical effects of the newly passed One Big Beautiful Bill Act, or OBBBA.
Right, OBBBA.
When you analyze the architecture of this legislation, it has a fascinating dual nature. It is literally pulling the domestic economy in two opposing directions at the exact same time.
Let's dig into that dual nature, because the first half of the equation is a massive injection of capital directly to households, correct? I saw the top line figures, but how does that actually flow through to the street?
Well, the legislation delivers roughly $191 billion in tax relief to households. But what really matters to the macro data is the velocity and the timing of that capital.
Meaning how fast it actually hits people's bank accounts.
Exactly. Roughly $141 billion of that is hitting the economy in the first half of this year, right now. It's coming through immediate tax refunds and reduced paycheck withholdings.
Which is a huge shot in the arm.
It is. Historically speaking, When you inject an income boost of that magnitude into the system, it acts as a direct, powerful stimulus. Econometric models typically show that this kind of cash injection boosts GDP by 0.3 to 0.5% over a couple of quarters.
Because it puts liquidity directly into people's checking accounts.
Right, which heavily supports consumer spending.
But wait, if that were the only thing happening, we would just see an acceleration in growth. The friction comes on the other side of the bill, the new tariffs. And a tariff is essentially a consumption tax absorbed at the point of sale, isn't it?
That is the exact point of friction. The legislation simultaneously introduces sweeping new tariffs on a wide variety of imported goods. And you are entirely correct about the mechanics there.
It hits the consumer directly.
Yes. When the cost of importing raw materials or finished consumer goods rises at the port of entry, those costs are rarely fully absorbed by the corporate margins. They are largely passed straight through to the end consumer at the register.
So you have this bizarre dynamic where the government is handing consumers tax relief in their right hand, but the rising cost of tariffed goods is immediately reaching into their left hand to take it back.
Exactly. And that dynamic is creating a front-loaded, temporary inflation spike, particularly in core goods. The market has to digest these new price floors.
Because supply chains don't just shift overnight.
They absolutely do not. Supply chains take time to reroute to avoid tariffs, and in the interim, prices go up. This is exactly why we are seeing that stall in core inflation around the 2.5% mark.
So it's not necessarily a permanent re-acceleration of inflation.
Not necessarily. The long-term disinflationary trend hasn't definitively reversed into a new inflationary spiral, but the tariffs have effectively acted as a dam. They are pausing the downward momentum while the new pricing reality sets in.
Which brings us to a major question about the consumer. Because when we talk about consumer spending absorbing these higher prices, we really can't talk about the consumer as a single homogeneous entity anymore.
No, the averages hide the reality right now.
The data is showing a profound K-shaped economic expansion. Let's look at the upper arm of that K first. The wealthiest 10% of households are an absolute juggernaut right now.
They are single-handedly holding up massive segments of the retail and services market.
It's incredible to look at. They are driving roughly half of all consumption in the entire U.S. economy. Half.
It's a staggering concentration of spending power.
And obviously, they're heavily insulated from localized inflation because they are riding the wealth effect. They've got soaring stock portfolios. They are locked into 3% mortgages from 4 years ago, and they are watching their home equity hit record highs. If milk costs $1 more, it doesn't even register on their radar.
What's fascinating here is how stark the contrast is with the lower arm of that K. The bottom quartiles are operating in an entirely different economic reality.
Yeah, they are feeling every single cent of that inflation.
They do not have the luxury of the wealth effect. Instead, they are facing decade-low wage growth. Their paychecks are fundamentally failing to keep pace with the sticky inflation we just outlined.
And we're starting to see the cracks in the foundation, right? I've been looking at the credit data, and it is flashing some serious warning signs.
Very serious warning signs. We are tracking a steady, notable rise in subprime auto loan delinquencies.
And that's usually the canary in the coal mine.
It is. In consumer finance, subprime auto is universally recognized as a leading indicator. People will prioritize their car payment over almost anything else because they need it to get to work.
So if they miss that payment,
When those delinquencies spike, it means the household budget is completely exhausted. Furthermore, we are seeing a marked increase in the percentage of households that have transitioned from paying down their credit card balances to merely making the minimum monthly payments.
which is brutal right now.
At current interest rates, making minimum payments is a pure debt trap. They are stretched incredibly thin.
So for you listening, especially if you are managing broader market allocations or corporate strategy, you might be wondering, why should you care if you aren't directly exposed to that specific demographic?
It's a fair question.
Here is the reality check. Consumer spending makes up an immense 70% of the entire U.S. GDP. If the lower end of the consumer base actually breaks under this pressure, doesn't the whole system eventually feel the tremors?
It absolutely does. The upper income cohorts can carry the aggregate numbers for a while. They can keep high-end travel and luxury retail booming.
But that's not the whole economy.
Exactly. A structurally sound, sustainable economic expansion requires participation across the entire income spectrum. Retailers, massive consumer packaged goods manufacturers, logistics companies, they rely on volume. And volume requires broad-based consumption.
But is there a silver lining here? What about that $141 billion in tax relief we mentioned earlier? If that money is hitting bank accounts right now, could it act as a bridge for those struggling households?
That is the bull case for the consumer right now. If those tax refunds provide just enough liquidity to let those households pay down some of that high-interest revolving debt or catch up on the auto loan, it could prevent a wave of defaults.
It just buys them time.
It buys time, and it could broaden out consumption just enough to stabilize the foundation while the economy adjusts to the new tariff regime. But it is a very precarious tightrope we are walking in 2026.
It feels like trying to balance a scale during an earthquake. And speaking of earthquakes, we need to talk about the geopolitical shockwave that completely upended the markets in late February and early March.
The energy markets were definitely shaken.
I'm talking about the sudden military escalation in the Middle East, the U.S. and Israeli retaliatory strikes against Iran. We saw immediate airspace closures and, crucially for the global economy, immediate credible threats to shipping in the Strait of Hormuz.
If we connect this to the bigger picture, you really have to understand the geography of global energy. The Strait of Hormuz is arguably the single most sensitive, volatile geographic choke point on the planet.
How much oil actually moves through there?
Roughly 20% of the world's total global oil consumption passes through that narrow waterway every single day. We are talking about roughly 21 million barrels of oil.
Which is an almost unfathomable amount of energy. So when a conflict erupts near there, the market doesn't wait to see if a tanker actually gets hit. The mere threat of a disruption or a blockade instantly prices a massive risk premium into the energy markets.
Exactly. The insurance premiums for shipping through the region skyrocket, and commodity traders immediately price in the worst-case scenario.
And we saw that panic play out in real time. West Texas Intermediate WTI crude surged towards $78 a barrel almost instantly. Brent crude crossed the $83 threshold.
The reaction was visceral.
And for the everyday economy, U.S. retail gasoline jumped 11 cents practically overnight. When consumers see the numbers spinning faster at the gas pump, it acts as an immediate psychological tax. It instantly impacts consumer sentiment and feeds right back into those inflation fears we were just discussing.
It absolutely does. It reinforces the narrative that inflation is returning. But this raises an important question, and it introduces a truly fascinating contradiction in the underlying macroeconomic data.
I know where you're going with this, and it is wild.
It really is, because despite this intense short-term panic, despite the headlines and the very real geopolitical risk premium, the structural long-term outlook for physical oil is overwhelmingly bearish.
Okay, hold on. Let me push back on that. A bearish outlook for oil during an active, escalating Middle East conflict. We just saw traders push Brent past $83 the second the strikes happened. Are you saying the market is acting purely on emotion and ignoring the structural data?
In the very short term, fear always overrides fundamentals. Traders are managing minute-by-minute risk. But if you zoom out and look at the physical realities of global oil production, the entire landscape has fundamentally shifted away from OPEC's dominance.
So where is the oil coming from?
We are currently observing a scenario where non-OPEC producers, specifically the U.S., Canada, Guyana, and Brazil, are pumping absolute record volumes of oil.
And the nature of that oil extraction is different now, isn't it? It's not just a guy turning a spigot on and off in the desert.
Exactly. A massive percentage of this new supply is coming from offshore deepwater drilling, particularly in places like Guyana and Brazil, alongside the continuous optimization of global shale. And here is the critical economic factor. This new supply is highly inelastic.
Meaning they can't just pause production to manipulate the price. Once the well is flowing, it has to keep flowing.
Right. When an energy consortium invests $4 billion to construct and position a deepwater production vessel off the coast of South America, they don't shut it down just because the spot price of crude drops by $10. To maintain the structural integrity and pressure of those deepwater wells, they have to run continuously. It acts as baseload global supply.
So because we have this massive, unstoppable production capacity completely outside the traditional OPEC quota system, the supply side of the equation is running hot. How hot are we talking?
Global oil supply is currently expanding at roughly 3 times the rate of global demand growth.
3 times.
Let that sink in. Supply is outstripping demand 3-to-1. It is a tidal wave of physical crude hitting the global market. Because of this, massive gluts are steadily building up in commercial storage facilities worldwide.
So there's nowhere to even put it all.
Exactly. When you look at the fundamental supply-demand models, many top-tier analysts are actually forecasting that Brent crude could fall to $50 or even $55 a barrel by the end of 2026 once the geopolitical noise clears.
That is a staggering disconnect. So the central tension for energy markets right now is essentially a staring contest. On one side, you have the psychological terror of a Middle East conflict and the threat to the Strait of Hormuz. On the other side, you have the sheer, inescapable physical reality of a tidal wave of oil flooding the global storage tanks.
That is the multi-trillion-dollar question for energy allocators. Historically speaking, geopolitical risk premiums in the oil market fade remarkably quickly if physical supply isn't actually destroyed or permanently blocked.
So if the ships keep moving, the price drops.
If the Strait of Hormuz remains navigable, even if the region is extremely tense, the gravitational pull of that massive physical oversupply will eventually drag prices down. The fundamentals always win over a long enough timeline. But of course, if actual pipeline infrastructure or major export terminals are severely damaged, all bets are off, and that risk premium becomes a physical reality.
So if you are sitting at the Federal Reserve right now, your dashboard is a complete nightmare. You've got inflation stalling out because of new tariffs. You have a bifurcated consumer base where the lower half is flashing warning signs on credit, and you have oil prices violently spiking on war news while simultaneously facing a long-term structural glut.
It is not an enviable position.
What exactly do you do? Because at their January 2026 meeting, the Fed's response was essentially to do nothing. They hit the pause button.
It was arguably the only prudent move available. After that string of rate cuts in late 2025 that everyone cheered, they held the benchmark rate steady at 3.5 to 3.75%. The Fed is essentially keeping its powder dry.
But why pause? If the lower-income consumer is breaking, as we just discussed, wouldn't they want to cut rates to relieve that pressure?
They want to, but their dual mandate restricts them. They are looking at the exact same data we are. Yes, the consumer is stressed, but the broader labor market is showing surprising resilience. We are looking at expected average monthly job growth of around 67,000.
Which isn't the booming 250,000 jobs a month we saw a couple of years ago, but it's certainly not a recessionary collapse either. It's a stabilization.
Exactly. It is a labor market that is bending, not breaking. And simultaneously, they see inflation stalling out. If the Fed were to aggressively cut rates right now to save the subprime auto borrower, they risk flooding the system with cheap credit exactly when tariffs and oil shocks are creating upward price pressure.
Oh, wow. They could spark a whole new fire.
They could easily reignite a second wave of inflation, which is every central banker's worst nightmare. Conversely, if they raise rates to kill the tariff-driven inflation, they risk entirely breaking that fragile lower-income consumer and plunging the economy into a deep recession.
So they are truly stuck.
A strategic pause is the only logical maneuver while they wait for the data to declare a clear direction.
And the market traders have had to violently adjust to this new reality. For the past year, the market has been aggressively pricing in rate cuts. But the odds of a June rate cut have plummeted from 70% down to 55% in just a few weeks.
The sentiment has completely shifted.
And looking further out, there is now nearly a 60% probability that rates just remain paused all the way through the summer of 2026.
The market is finally waking up to the higher-for-longer reality.
And for you listening, this higher-for-longer environment isn't just an abstract bond market concept. It has visceral, direct implications. It means your mortgage rates are going to stay elevated, locking the housing market in its current frozen state.
Yes.
It means the financing on commercial real estate deals is going to remain painfully expensive. It means the interest compounding on those credit cards we mentioned is going to act as a continued, persistent brake on the overall economy.
And we must factor in a massive looming variable regarding the Federal Reserve itself that isn't purely economic, it's structural. The current Fed chair's term ends in May of 2026.
Right, and any time there is a transition in central bank leadership, especially in a highly polarized political environment, it introduces a massive layer of uncertainty. I know there is a lot of market anxiety right now about the potential politicization of the Fed.
It is a major topic of discussion on trading floors.
There's always chatter about the executive branch wanting to install someone who will dramatically lower interest rates to boost the economy, regardless of what the inflation data says.
Impartially speaking, that tension between the executive branch and the central bank has existed across multiple administrations for decades. Presidents always want lower rates to fuel growth. However, it is crucial to reassure investors and corporate planners by looking at the institutional guardrails that are firmly in place. The Federal Reserve Chair does not operate as an autocrat.
They can't just walk into the office on Monday and declare rates are zero.
Exactly. Any major monetary policy shift, like cutting or raising the benchmark rate, requires a strict consensus. Specifically, it requires a majority vote among the 12 voting members of the Federal Open Market Committee, the FOMC.
So it's a structural barrier.
Very much so. 7 governors are appointed for staggered 14-year terms, specifically to insulate them from political cycles, alongside 5 regional Fed bank presidents. So while a newly appointed chair certainly sets the tone, dictates the agenda, and acts as the public face of the institution, they cannot unilaterally force a dramatic pivot in policy.
They still have to win the votes.
They have to convince a room full of deeply entrenched economists who are rigorously studying the very same inflation and employment data we are.
It's a great perspective. It's a massive institutional ship, and it turns very slowly, deliberately, regardless of who is temporarily standing at the helm. Now, if credit is staying that expensive for that long, and the consumer is showing signs of fatigue, you would naturally assume that corporate balance sheets would be showing the strain. But Wall Street seems to be operating in an entirely alternate dimension right now. The numbers we are seeing out of the stock market are almost hard to believe, given the macroeconomic friction we just spent 20 minutes discussing.
The divergence between the real economy and the financial economy is striking right now.
Here's where it gets really interesting, because the earnings engine of corporate America is absolutely roaring. Let's look at the actual reporting. Q4 of 2025 delivered a 14.2% year-over-year earnings growth.
That is massive.
And that wasn't a one-off fluke. It was the 5th consecutive quarter of double-digit growth. We're looking at projections from top analysts, estimating that S&P 500 earnings will rise over 14% for the entirety of 2026. Corporations, particularly at the top of the index, are incredibly historically profitable.
They are operating with a level of ruthlessness and efficiency that is remarkable. Much of that margin expansion is driven by the technology sector, which we will deep dive into shortly, as they leverage automation and pare back bloated workforces.
Right.
But as any disciplined investor knows, we cannot look at earnings in a vacuum. The absolute price you are required to pay for access to those earnings matters immensely.
Right. It doesn't matter how great a company is if you are paying $50 for $1 of future profit. So what are the valuation metrics actually telling us right now?
They are flashing bright red. The forward PE ratio, the price-to-earnings ratio, looking at estimated profits over the next 12 months, is sitting at a highly stretched 21.6.
21.6.
To contextualize that, historically, a healthy market averages around a 15 or 16 PE. At 21.6, investors are paying incredibly high, historically rare premiums for future profits. You are paying a premium assuming that nothing will go wrong.
And when you look at the broader macro valuation indicators, it gets even more extreme. I want to bring up the Buffett indicator.
It is one of the most reliable, ungameable metrics we have.
For those who might not track it daily, the Buffett indicator is a metric popularized by Warren Buffett. It is beautifully simple. You take the total market capitalization of all publicly traded U.S. stocks and you divide it by the total U.S. gross domestic product. It is effectively a measure of the stock market's size relative to the actual physical economy it is supposed to represent.
What is that ratio sitting at today?
It just hit 220%.
Which is astronomical.
To put 220% in perspective, if we rewind to the absolute peak of the dot-com bubble in the year 2000, a time characterized by literal irrational exuberance, the Buffett indicator barely crossed 200%. We are well past the dot-com peak valuations. To quote Buffett's famous warning about this specific metric, when the ratio gets this high, you are playing with fire.
That is the exact right phrasing.
It's like looking at a Jenga tower, where someone has removed all the structural bottom pieces and you are just waiting for someone to sneeze.
That is a highly apt metaphor. It is an incredibly precarious position for equities. When valuations are stretched to a 21.6 forward PE and a 220% market-to-GDP ratio, the market is pricing in absolute undeniable perfection.
Which never happens.
Never. It assumes that corporate earnings will hit or exceed every single optimistic target. It assumes inflation will perfectly subside without the Fed raising rates. And it assumes all geopolitical shocks in the Middle East or elsewhere will simply blow over without disrupting supply chains.
And reality is rarely perfect.
When reality inevitably falls short of that priced-in perfection, the downside risk is severe because there is absolutely zero margin of safety built into the current stock prices.
And we actually saw a glimpse of how vulnerable this market is in early March. The S&P 500 slipped 1.4% over just a few trading sessions. People got spooked by the oil shock and the sudden realization that the Fed isn't coming to the rescue with immediate rate cuts. It felt like the market suddenly remembered that gravity exists.
If we connect this to the bigger picture, we also have to consider the historical seasonality of the market. The year 2026 is a midterm election year in the United States.
And markets notoriously hate midterms.
They despise the uncertainty. A midterm election threatens a change in the balance of power in Congress, which translates directly to potential changes in corporate tax policy, regulatory frameworks, and federal spending priorities. Markets cannot price in policy that hasn't been written yet.
So the volatility naturally spikes.
Because of that inherent structural uncertainty, historical data shows that the S&P 500 experiences an average peak-to-trough decline of 17% during midterm election years.
A 17% drop in today's market would wipe trillions of dollars off the board. It would be a serious wake-up call for a whole generation of retail investors who have gotten used to looking at a chart that only goes up and to the right.
And the foundational data is starting to show some subtle cracks that could easily serve as the catalyst for that kind of historical decline. We recently saw Q1 2026 earnings per share estimates broadly revised downward by institutional analysts. This negative revision trend was particularly pronounced in the healthcare and energy sectors.
So the E in the PE ratio is actually shrinking.
Exactly. When you have a market trading at a 21.6 forward multiple and the actual earnings estimates that support that multiple start shrinking, those high valuations become highly vulnerable to any further bad news. The math simply stops working and the multiples contract violently.
It is a skyscraper built on a very narrow foundation. But amidst all this macro anxiety and valuation fear, there is one sector that seems to be operating in its own entirely different reality, completely defying all economic gravity.
The one everyone is talking about.
Let's pivot to the brightest, most intensely focused spot in the global economy right now, artificial intelligence. We are not just talking about cool chatbots anymore. We are in the midst of a multi-trillion-dollar capital expenditure boom that is reshaping the physical world. The numbers are staggering. In 2025 alone, hyperscalers, the massive tech giants like Microsoft, Amazon, Google, who run the global cloud infrastructure, spend over $350 billion on AI infrastructure.
It's hard to even conceptualize that much money.
Let me contextualize that for everyone. That single line item, $350 billion, is equivalent to over 1% of the entire U.S. GDP.
That level of concentrated capital expenditure is historic. You really have to look back to the build-out of the National Railroad System in the 19th century, or the laying of the original fiber-optic internet backbone in the late 1990s, to find a comparable deployment of capital. But to truly understand the sheer scale of the AI supercycle, we have to look past the software.
We have to look at the physical footprint.
We have to look past the large language models and the code. We have to connect AI to physical reality.
Right, because the cloud isn't actually a cloud. It is a massive, incredibly loud, incredibly hot, windowless building full of humming servers.
Precisely. The physical reality of AI is the hyperscale data center. And the raw computational power required to train and continuously run these advanced next-generation AI models is staggering. A single ChatGPT query requires nearly 10 times the electricity of a standard Google search.
10 times the power just for one prompt.
Because of this exponential increase in compute density, data center electricity demand has quintupled over the past 10 years.
Quintupled. And that is just the beginning of the curve, right?
It is the very bottom of the hockey stick. Looking forward, conservative industry projections indicate this power demand could reach an astounding 176 gigawatts by the year 2035.
176 gigawatts.
To put that 176 gigawatts in perspective, that is a five-fold jump from where we were just a couple of years ago. It is roughly equivalent to the entire power grid capacity of a major industrialized nation dedicated solely to running AI data centers. AI has an absolutely insatiable need for power,
which is causing massive ripple effects across commodity markets that you might not immediately associate with tech. Earlier, we talked about the long-term bearish outlook for oil because of deepwater drilling. But natural gas is experiencing a massive bullish divergence from crude.
A completely different trajectory.
We are seeing natural gas prices projected to push past the $4.30 per MMBtu mark. For anyone tracking wholesale heating and power generation, crossing that MMBtu threshold is significant. Why is gas surging while oil gluts? Because you need natural gas turbines to fuel the massive electrical generation required to keep these AI data centers running 24/7.
You've hit on a critical infrastructure reality. Everyone loves the narrative of running the future on wind and solar. But renewable energy is, by its very nature, intermittent.
The wind stops blowing, the sun goes down.
Exactly. An AI data center running a multi-billion parameter model cannot experience a millisecond of power interruption. It requires what the industry calls baseload power. It needs massive, continuous, highly reliable energy. Right now, and for the foreseeable future, that reliability is primarily supplied by natural gas and nuclear power.
This raises an incredibly important point about investment opportunities. When the average person thinks of investing in AI, they look at the semiconductor designers, the chip manufacturers, or the software giants. But the massive infrastructure demands of AI are transforming entirely different, historically overlooked sectors.
It is the classic picks and shovels play during a gold rush, but playing out on a macroeconomic scale.
Exactly. Look at the utility sector. Historically, utilities were the most boring equities you could possibly own. They were the classic widows and orphans stocks. You bought a regional utility because it paid a steady 4% dividend, the stock price barely moved, and you held it for absolute safety.
They were basically bond proxies.
Not anymore. The utility sector has caught fire. They returned over 20% in 2025, and they posted a massive 23.1% year-over-year earnings growth in Q3. They have gone from being a defensive portfolio anchor to a completely dynamic growth sector.
They have been entirely re-rated by the market because they are at the absolute epicenter of the physical AI build-out. The U.S. electrical grid, which is aging and frankly quite fragile, is currently undergoing an estimated $1 trillion upgrade.
$1 trillion just on the grid.
Regional utility companies are the localized entities tasked with executing this massive undertaking. They are the ones who have to build the substations, lay the high-voltage transmission lines, and deliver that firm capacity. They are delivering uninterrupted, reliable power specifically tailored to the rigorous, massive demands of hyperscale data centers.
But doing $1 trillion grid upgrade isn't cheap. And historically, when a utility needs to build a new power plant, they go to the local regulators and ask to raise the rates on everyday consumers. But you can't just double the power bill for millions of homeowners to fund a data center for $1 trillion tech company. The politics of that are toxic. So how are they paying for this?
It requires highly innovative, complex corporate financing. Traditional retail rate hikes are politically unviable, so utilities are utilizing advanced mechanisms. They are leaning heavily into tax credit monetization, essentially selling green energy tax credits generated by parallel solar projects to corporate buyers.
Okay, that's clever.
More importantly, they're utilizing advanced securitization. They are structuring long-term, ironclad power purchase agreements directly with the tech giants. The tech companies agree to pay a premium for guaranteed power over 20 years, and the utility uses that guaranteed contract to secure the massive upfront financing needed to build the infrastructure, completely bypassing the retail ratepayer.
So for you listening, here is the vital takeaway if you are trying to understand the market. AI is no longer just a software story. It has rapidly matured into an infrastructure story, a real estate story, and fundamentally an energy story. If you are only looking at tech stocks to play the AI boom, you are completely missing the massive physical footprint that is required to make it all work. The companies laying the industrial cable, engineering the liquid cooling systems, and generating the megawatts are presenting entirely new, highly lucrative investment angles.
It is the physical manifestation of the digital revolution.
Moving on from the immediate, deafening frenzy of AI, I want us to look at the future frontiers. The foundational structural shifts that are quietly happening right now, setting the stage for the next decade of capital allocation. First, let's touch briefly on the fixed income markets, the bond market, because something fundamental has shifted there that completely alters how we traditionally think about safe money.
What's fascinating here is a slow-moving paradigm shift in how global institutional investors perceive foundational risk. Traditionally, in modern finance, sovereign government debt, specifically U.S. Treasuries or German bunds, was the ultimate, unquestionable safe haven. The foundational assumption of the global financial system was that a G7 government, with the power to tax and print its own currency, would always pay its debts. It was the risk-free rate.
But the fiscal reality of those governments has drastically deteriorated over the last few years.
We are witnessing an era of massive, persistent, almost structural deficit spending by these same G7 governments. The fiscal discipline that used to implicitly backstop sovereign debt is eroding rapidly. National debts are expanding at a rate that is mathematically concerning relative to GDP growth.
So if you are managing a massive pension fund and you need absolute safety, but you are increasingly nervous about government deficits, where does the safe money actually go?
It is migrating toward the top tier of the corporate sector. We are seeing a structural shift where institutional investors are increasingly viewing high-quality, investment-grade corporate bonds, think of debt issued by cash-rich tech monopolies or massive healthcare conglomerates, as actually safer than sovereign government debt.
Which sounds completely upside down. Loaning money to a corporation is safer than loaning it to the U.S. government.
Based on the balance sheets, yes. These megacorporations have generally maintained much stricter fiscal discipline than governments in recent years. They sit on hundreds of billions in cash reserves and have incredibly predictable, high-margin revenue streams. This shift in perception and capital flows is leading to a steepening yield curve and is fundamentally changing the very definition of what constitutes a risk-free asset in the 21st century.
It's a wild structural evolution. Now, I want to pivot to a frontier that I find incredibly exciting and, frankly, a bit mind-bending. If artificial intelligence is the current technological revolution that is dominating the headlines, there is another revolution waiting right on the horizon that could be exponentially more disruptive: quantum computing. We hear the term thrown around constantly in sci-fi movies, but this is transitioning from theory into very, very real economic consequence.
It is actively transitioning from theoretical physics in university labs to applied engineering in corporate R&D departments. To understand where we are in the investment cycle, we have to look at the industry roadmap. Currently, we are in what quantum physicists call the NISQ era. That stands for Noisy Intermediate Scale Quantum.
Break that down for us. What does noisy mean in the quantum context?
It means these early quantum computers physically exist and they actually work, but they are incredibly fragile. The qubits, the quantum equivalent of a digital bit, are highly susceptible to environmental noise. A slight change in temperature or even stray electromagnetic radiation causes calculation errors. They lack the ability to self-correct.
But the leap is coming. The transition to the next era is what the smart money is tracking.
Exactly. The holy grail of the entire industry is FTQC, fault-tolerant quantum computing. This is the stage where the hardware and software mature to the point where the machines can logically correct their own errors in real time, allowing them to scale up and solve problems of staggering complexity without crashing. Industry roadmaps, driven by tens of billions in aggressive R&D from both major tech players and state-sponsored labs, project that practical FTQC will arrive in the early 2030s.
And we have to emphasize for you listening, a quantum computer isn't just a faster version of the laptop you are using right now. It isn't just a supercomputer with more microchips. It is a completely new paradigm of computation.
It solves problems in a fundamentally different way. While classical computers process information in binary zeros and ones, quantum computers utilize quantum mechanics, operating at the subatomic level, allowing them to process vast arrays of possibilities simultaneously.
Which means the implications for the physical economy are profound.
World-changing. Once we achieve fault tolerance, quantum computing represents a complete revolution for fields constrained by classical computing limits. Take material science. We could perfectly simulate molecular structures at the atomic level to discover flawless, hyper-efficient solid-state battery chemistries, or design highly targeted new pharmaceutical drugs in days without years of physical, trial-and-error laboratory synthesis.
And think about logistics. It will completely revolutionize global supply chains, optimizing millions of variables in shipping routes, weather patterns, and fuel consumption in ways classical computers simply cannot calculate.
From a macroeconomic perspective, conservative estimates suggest we are looking at a potential $1 to $2 trillion economic unlock across multiple industries in the first few years of FTQC deployment alone.
It's the kind of paradigm leap that makes our current technology look like the telegraph. The companies, or frankly the nations, that crack FTQC first are going to possess an almost insurmountable economic and strategic advantage. So, what does this all mean? We have covered a tremendous amount of ground today, from the aisles of the grocery store to the subatomic realm. Let's emphasize this for you.
It is a lot to take in.
It is. As of March 2026, we are living in a world defined by a massive, powerful central tension. On one hand, we have an economy being actively propelled forward by truly historic corporate earnings. This is driven by an AI supercycle that is aggressively boosting corporate productivity and demanding a trillion-dollar infrastructure and energy build-out. The technological engine of the economy is burning white hot, and the wealthiest consumers are spending relentlessly.
That is the bull case.
But on the other hand, that very same economy is heavily threatened from multiple angles. It is threatened by equity valuations that are stretched to dot-com bubble extremes, leaving absolutely zero margin for error if earnings falter. It is threatened by a sticky, tariff-driven inflation saw that is actively squeezing the lower-income consumer to the breaking point of credit defaults. And it is threatened by volatile geopolitical energy shocks, like the conflict in the Middle East, that could send oil prices skyrocketing and reignite inflation, despite a massive structural oversupply of physical crude.
The balance is incredibly fragile.
It is a brilliant, fragile, and highly polarized moment in economic history.
And as we navigate this polarization, I want to leave you with a final, lingering thought to ponder as you look at your own strategies. As the AI supercycle and the dawn of quantum computing demand unprecedented amounts of electricity, we have to ask ourselves, in the future economy, will the ultimate technological superpower be the nation that writes the best code, or simply the nation that can generate the most power?
That is the ultimate question for the next decade of investing. Thank you so much for joining us on this deep dive. We hope this exploration has helped you cut through the daily noise and clearly see the underlying architecture of the market right now. Keep questioning the narratives behind the headline numbers, stay fiercely curious about where the data is pointing, and we'll see you on the next deep dive.